This is Lawrence Zanuck at the Home Seller Homebuyer Podcast with Homebuyer episode number 8. How much money do you need to buy a house? How much money do you need to buy a house? The first step and most critical in the house buying process is getting pre-approved. Buying a house is still considered to be a lifetime accomplishment. How much cash you're going to need up front to do so is another story. The funds needed to close the sale play an enormous role in your ability to get a house loan. If you're serious about buying a house, or will be in the future, you will need to know how much of your income you should be saving to realistically seal the deal. A short-term plan. Lenders look at your pre-tax income when determining how to qualify you for a loan. As a would-be house buyer, you should plan on doing the same, using a percentage of your gross income for determining how much to save. Saving 20% of your income could catapult you into possibly purchasing a house in the next 12 to 16 months, depending on your market. For example, if you're earning $96,000 per year, that's $19,200 saved after 1 year and $28,800 saved after a year and 6 months, which can be plenty of funds to make house ownership a reality. Longer-term plans. At least 10% of your pre-tax income is a great place to start planning for the future of house ownership. Using the same example of $96,000 of income, that's $9,600 per year allocated for house savings. If you would only take an extra year to come up with the same type of cash in the short-term plan, 1 year goal. Taking a percentage of your income is certainly no easy task. It requires diligence, attention to detail, and financial discipline to consistently put that money in the bank despite other debts and household expenses. Income sources to supplement your house buying plan can be various ones. While the following are potential sources for a down payment, make sure you consult with a financial advisor before you tap into your nest egg to make sure it is the best move for your needs. With that said, here are some options. 401ks. If you have an employer match a percentage of your monthly contribution, this can aid you in purchasing a house faster, as the majority of 401k accounts have the ability to borrow for buying a house as a first-time buyer. For example, if you are receiving a 50% match of your monthly contributions in your 401k, you can kickstart the time it takes you to save the cash. An IRA. These accounts grow with the market and have the same concept as a 401k, although without the matching. Such an account is great to place accumulated money in an interest-bearing account that has provisions to purchase first house. CDs and money market accounts. These accounts are also a source to help you generate additional funds to save in addition to your monthly savings contribution. You can even set up electronic funds transfer from your paycheck to funnel into these other banking sources in the event saving that money on your own becomes too difficult. It all comes down to your house price. When buying a house, there's the down payment, which is the difference between the purchase price and the loan amount, and then there are the closing costs. Those two costs will equal the total cash needed to close. Closing costs are roughly 2 to 2.25% of the purchase price. So if you're looking at a house for $500,000, plan on closing costs to be around $10,000. How much down payment is needed will vary depending on the loan program. If you're using a conventional financing, you can get conventional financing for as little as 5% down payment, and if the down payment is less than 20%, it may be necessary for the loan to have private mortgage insurance to protect the lender. Terms usually around 15 to 30 years, and the interest rate stays the same for the life of the loan. If you do FHA financing, insure loans, making lenders willing to finance house purchases on favorable terms. Down payments as low as 3%. Discount points may be paid by either seller or buyer. The term varies by lender. However, the FHA charges an upfront mortgage insurance premium similar to private mortgage insurance that can be financed in the mortgage amount or paid in cash at settlement. The borrower must also pay an annual mortgage insurance premium of a half a point, which is collected monthly. USDA financing. The maximum loan amount an applicant may qualify will depend on the applicant's repayment ability. The applicant's ability to repay a loan considers various factors such as income, debts, assets, and the amount of payment assistance applicants may be eligible to receive. Regardless of repayment ability, applicants may never borrow more than the area's loan limit, plus certain costs allowed to be financed for the county in which the property is located. What is the interest rate and payback period on a USDA loan? Fixed interest rate based on current market values at loan approval or loan closing, whichever is lower. Interest rate when modified by payment assistance can be as low as 1%. Up to 33-year payback period or 38-year payback period for very low-income applicants who can't afford the 33-year loan term. No down payment is required. Applicants with assets higher than the asset limits may be required to use a portion of those assets. VA financing. Available to qualified veterans of the armed services, reserves, and National Guard. Loans can exceed $200,000 with no payment. Flexible underwriting guidelines. Closing costs may be a gift, can be combined with second mortgages, and are assumable upon qualifying by future buyer. The term, fixed for the full term. The interest rate varies by lender. Navy Federal Credit Union. Needs no down payment. Restrictions as to who can apply: members of the military, some civilian employees of the military, and U.S. Department of Defense and family members. This type of loan may not always be available. Adjustable rate mortgage. Characteristics of these are low interest rate with payments that typically increase over time, popular with first-time buyers and buyers who plan to move or refinance in the next 3 to 5 years. Term varies by lender. Interest rate subject to change on a periodic basis. Balloons. Lower interest rates and monthly payments than fixed loan rates, best for borrowers who plan to move or refinance within the loan term. May allow conversion to a fixed rate at term's end. Terms are normally 5 to 7 years, with amortization over 30 years. Repaid in equal monthly payments plus a balloon payment for the remaining balance. Interest rates varies by lender. You have a buy down. The house owner, builder, or third party puts additional cash up front in exchange for a lower interest rate. Term will vary. Interest rates vary. Non-conforming. Provides house buyers with products that do not conform to normal FHA, VA, and conventional lending guidelines. These unique loan products are tailored to fit specific financial situations, including bankruptcies less than 2 years from discharge, no income, no asset verification loans, late payments on previous or current mortgage, bank statement programs for the self-employed, or excessive credit problems but sufficient liquid assets to work with. Term varies, interest rate varies. Owner assisted. Owners may finance first, second, or third loans. They may loan their equity back as a mortgage, often called a take-back. Term, as determined by the owner. Interest rate, as determined by the owner. And you very seldom see this type of loan. So how do you determine your costs? Let's look at a house priced at $500,000. Given certain criteria, $27,500 is what it would take to close the deal. Here's the math. $500,000 purchase price, $10,000 closing costs at the 2 to 2.5% of purchase price, and $17,500 with a 3.5% FHA down payment, giving you a total cash payment of $27,500 needed. Remember, as you are diligently saving a portion of your income to make that house purchase happen, a lower down payment and lower total cash to close means a higher monthly mortgage payment. Conversely, a larger down payment gives you a lower mortgage payment. Also, the percentage of mortgage insurance lowers if the buyer uses more equity. If you have been diligently saving for a house and still have not been able to purchase a property and are diligently saving your money, talk to a lender about getting pre-approved. perhaps it's time to reevaluate how much percentage of your income is going into savings versus what houses are like in your area. To learn more about the mortgage insurance, use the link on our show notes. Thank you for listening to Homebuyer Episode 8. We are grateful for the time you have taken to listen to this podcast, and we look forward to your input on what you would like to hear in future podcasts. You can find the show notes at homesellerhomebuyer.com, and you can leave your questions, suggestions, and comments there, or you can email us at info, that's INFO, at homesellerhomebuyer.com. Tell your family, friends, and coworkers about Home Seller Homebuyer Podcast. Thank you for taking the time out of your busy day to listen to the Home Seller Homebuyer Podcast and catch us on the next episode. Thank you for listening, and stay informed.